All right, I think we're good to start. Hello, everyone. I'm Sagar Lele. I think I'll quickly introduce some of the team members that we have here before starting. Um, so, everybody from Repeating, if you can just put your videos on, say hi. Okay, so
Hello
we've got.
everyone.
Hi guys.
Okay. So there's Chaitanya, Harsh, and Aditya from the team who've joined in today. Chaitanya, important part of research. Aditya, many of you would have actually interacted with Aditya because he's sort of the singular customer touchpoint at this stage. Whether it comes to sales or helping people out in investing or even addressing some regular questions. Aditya is the face of repeating at this point. So he was putting a face to the name. And Harsh has joined us recently. He's also part of mainly driving a lot of the Voyager initiatives. Um, so three of us here at this point. Cool. So I think let's start. Probably we'll just start a little bit with what we do at Repeating, just to give you a brief idea for anybody who's not invested with us so far. So Repeating started 3 years ago. We are an investment advisory firm. We're registered with SEBI as an investment advisor. We've got a corporate registration. And we've been operating on small case for the last a little more than 3 years now. So we started with some ETF portfolios, but introduced equity portfolios soon after, and we've now got 6 small cases which are equity focused, and 3 ETF focused portfolios. Um, and along with that, we had some presence on some other platforms as well, like Wealth Desk, and then a couple of more. But small case has been the sole survivor in this entire asset class. And we are one of the fastest growing on small case at this point. For a couple of years, we were also the best performing. Value migration has been our star product, and that has performed really well over the last 3 years. Most people here would also be invested in the value migration small case. So that's one. And the second thing is that we started a new product just about, I think, 6 months ago called Voyager. So Voyager is a product which initial days it's still just out of the womb, so we're still performing really well, but still sort of tweaking the product and seeing how to make it better. So constantly taking feedback from our customers and seeing how we can improve on that. Harsh, if you can actually change slides, that will be good. So that's the agenda for today. We'll just talk a little about repeating, see what the performance has been both in small case and in Voyager. Talk a little about how we look at the markets at this point in time, and then of course how we are positioning ourselves in terms of the portfolio and what the strategy going forward is. We'll open it up to everybody to ask questions within probably 20 minutes or 30 minutes, so that there's a fair chance that everyone gets. If you've got any queries, suggestions, feedbacks, we're all ears in. So yes, Harsh, if you could, sorry, 2 slides you can skip maybe. Yeah, so products we've spoken about. I think the other thing update which people keep asking us is another product that we launched is the PMS, and that is in partnership with this company called Patterson Securities. We've got some members from Patterson here as well, but probably too early for an introduction. Next time we can do that. And Patterson is a Chennai-based company. They've been in the broking business for the last over 100 years. They're one of the oldest stockbrokers in India, and we've partnered with them for the PMS. Recently launched, but amazing traction within just a few months of launch. We are already at double-digit crore AUM. Obviously, aims are much higher, but we've got a good start. So Yeah, so I think performance-wise, we'll focus on small case first. What we encourage all our investors is to look at us as long-term investors. We are not people who take short-term calls. We might churn the portfolio very minimally, and our bets are usually 3 to 5 years of time horizon. And we are people who pick up stocks and companies that are good long-term businesses, and we like to play cycles which are long-term. So that has been the philosophy for the entire research team, all the portfolio managers, whether it is in small case or in Pattison or in Voyager. And that's what will reflect in our performance as well. If you look at our 3 year performance, all the equity portfolios have significantly outperformed the broader markets. And obviously, in the short term, you'll have some portfolios outperforming, some underperforming. Those cycles will continue to vary our performance on a portfolio to portfolio basis. But we constantly encourage investors with us to look at us from a 3 to 5 year perspective. If you're in the short term game, you might at some point in time be extremely happy with our performance, at some point in time be extremely disappointed, and that variation will always exist. We try to adjust ourselves in the short term to shield ourselves from macro problems or even sectoral rotation themes. So we try to maintain performance even on a near-term basis. But significant outperformance to markets and wealth creation is what we chase, and that will only happen in the long term. So if you look at our performance, value migration has been the top performing small case in the last 3 years. Even in the entire small case ecosystem, 170% return for a well-balanced, non-concentrated, non-sector focused portfolio is quite commendable. But obviously, if you look at the 1 month and 6 month performance, it has been disappointing, right? But any of you who've been invested in this small case long enough, people have made some serious money in value migration. The other one which has caught up significantly is socially responsible investing. This is a portfolio where we avoid taking bets in sectors like defense, or sectors which involve, say, tobacco consumption, or we follow typical, or even corporate governance. I think that is one of the major focuses, to avoid companies with any sketch marks on corporate governance. So that has performed really well as well, especially in this environment. What's happening is that we're seeing some very high pickup in monopolies and disruptors in the last 1 month, and that's primarily because the approach in monopolies and disruptors is to pick up is a very bottom up approach and a stock focused approach. What's happening in the market right now is that it's becoming a stock pickers market. The last 3-4 years, anything that you touched would perform well, but that's not the scenario any longer since the last few months, and that will not continue to be the scenario for the next few. So we think there will be a lot of performance divergence amongst fund managers, and people who pick up quality stocks will do much better. So that bottom up approach is clearly reflecting in outperformance in both monopolies and disruptors, where we are very, very stock specific in terms of portfolio construction. Moving on to Voyager, here portfolio analysis becomes a little difficult because every portfolio is personalized. The theme of investing here is that we take over someone's existing portfolio, and we make changes to them, and constantly monitor and rebalance those portfolios. Everyone's portfolio is also different from each other because everybody's requirements are different, their risk profiles are different. So no two people will have the same portfolio in Voyager. So performance calculation becomes a little difficult. Sometimes when people are very highly risk averse, or they have a very low risk tolerance, what happens is that our portfolio is very conservative. We are very highly placed in large caps for them. We have a lot of structural bets. We have a lot of defensives. So when we create a safe portfolio, they are bound to sometimes underperform the broader market, because that's the whole objective of the portfolio. However, I think if we stack up the numbers for Voyager, what we've seen is that in the core portfolio that we've recommended since starting the product, 90% of the customers' core portfolios after our recommendations have come in have outperformed the broader markets. And in the satellite portfolio, we've got a much more methodical performance calculation. That's because the same recommendations go to all investors for the satellite portfolios. So there, on average, we've given a 10% return on every single pick that we've delivered. Our average holding period for our stock picks is about 30 to 45 days. It varies between that time period. So 10% return on average over a month or 45 days is what you can consider, which comes to an annualized return of 47%. And a win ratio of 82%. So we've gone right on 8 out of 10 of the stock recommendations that we've given in the satellite portfolios. So that's also performing well despite market conditions being tough, which we're pretty happy about. Yeah, coming to how the portfolios are positioned. We'll just cover the market view a little bit before moving there. Yeah, so I think just a little bit of sort of background. Anybody who's been invested for the last 3-4 years, you know how well the markets have performed. 2020 to 2024 post-pandemic, the Indian markets have seen a phenomenal run. And that can be attributed to three things in our opinion. One is the fact that the Nifty earnings CAGR itself has been extremely high. If we look at the earnings CAGR from 20 to 24, it's come to a 24%. And that is extremely high compared to what we've delivered in the past and what normalized returns are. So 24% earnings CAGR. The second factor is domestic inflows have been extremely strong. We've seen over $100 billion pumped in through domestic money itself into the Indian markets from 2021 to 24. So over the 3-year period. And this number is almost, say, 8x of what the foreign inflows have been. So extremely strong domestic inflows into the equity markets have been another reason for absorbing most shocks and the rise that we've seen. And the third factor is political stability and a lot of the fiscal measures that have taken place over the last 3 years. So the government was extremely aggressive on fiscal spending, infra spending, and was driving a lot of the GDP growth because when government spending is increasing by, or capex spending is increasing by 20-30%, that drives a lot of the growth and gives you a multiplier effect as well. So that has been another key driver. And all this in the context of what we need to understand is that the global economy over the last 3 years, 4 years wasn't performing well. So you were in a place where inflation was extremely high globally, triggered a lot by post-COVID boost as well as Russia, Ukraine and other supply disruptions. But India was able to, on the other hand, manage inflation well because of monetary policy. And at the same time was able to show growth while the other economies weren't really growing. So this relative outperformance of India is what left us in a place where globally, if anybody had a safe place to invest in or visibility of growth, that was India. So India had become the preferred destination for investing and the most obvious sort of choice when it comes to where to put your money. So all of these factors resulted very well in stock market performance over the last 4 years. And why I'm sort of going back in a recap zone is because why is that not true for the last 2-3 months is what we need to understand. I think the first crack started appearing when the general election outcome was not a resounding majority as it was in the past. So that was the first crack that appeared. Although we've got the same government, the majority was lower compared to what was in the past few years. So what that essentially does is that the government priority started shifting, and you can see that in the budget that was presented in May as well. So the budget clearly sort of highlighted a shift from heavy infrastructure and capex spending and fiscal spending to two things. One is fiscal prudence, and the second being welfare spending. So that shift from capex or infra spending to welfare spending is what also tilted a lot of the equation that we see today, and could also be attributed to the slowdown we see, because one is election time anyway, government spending is low, and after that the budget reduced the growth of government spending. So capex spending is materially lower in FY25 compared to what was in FY24. So growth has been only 11%. That is in the budget. But so far in the 7 months of FY25, the government has managed to spend only 42% of the budgeted expense. So even despite the budgeted expense itself being lower growth, there is further sort of a dip in spending, and that is reflecting in GDP growth. Yesterday, I think. We saw numbers. 5.4% was the GDP growth for the second quarter of FY25. This is materially lower compared to 8% we were at last year, and about 6.4% in the previous quarter. So that slowdown is clearly reflecting, thanks to government spending being low, as well as private consumption itself being low. So these factors are resulting in, of course, a dip in corporate earnings as well. What we saw in the past, as I discussed, 24% earnings CAGR. In the second quarter of FY25, earnings growth was just at about 4%. So massive decline when it comes to corporate earnings. And expectations are that the third quarter is also going to be weak. Most corporate earnings calls reflected weakness and spoke about the weakness continuing in the next quarter as well. So we're expecting 0% or flattish YOY growth in corporate earnings in the next quarter. So FY25, if we look at overall, we're expecting growth to be about 8%. Compared to the double digits we've seen earlier. So this soft data is also reflected everywhere. Auto numbers, GST numbers, power consumption, everywhere we are seeing this slowdown, and that's what you're seeing in the markets. That's the slowdown we've seen in October and November, when the markets have underperformed. And this is what is causing the trouble. I think on top of that, usually when earnings slow down, the market impact can be lower if valuations are comfortable. But that also wasn't true for India, because it became the preferred destination and there was so much liquidity. The Indian markets were trading at an all-time high valuation. Where even the mid-cap premium, if you look at mid-caps, are trading at a 60% premium compared to the Nifty 50. And if you look at the Nifty 50 valuation, or the overall market valuation, the current market cap for India is 150% of its GDP, which is also an indicator of how heated the market is. So in such a situation, obviously, you will see some pressures. However, I think this again, markets go through cycles, earnings go through cycles, everything goes through cycles, and we think this cycle is just a part of the long-term story which remains intact for India. So if you could just move to the next slide, Harsh. Sorry, one more. There are those two charts that we've put, just highlighting. Yeah. So here, I think sorry, I think the next one. Chaitanya, you know where that chart is, right? Where we'd highlighted the GDP growth.
GDP growth versus the earnings growth, right?
I think that's the next. Sorry, that was another presentation. Sorry. Go. Yeah, okay. Anyway, so no, the point I was trying to make is that if India is looking at becoming a developed nation by 2047, if we are looking at GDP doubling up over the next 7 to 10 years, what we're looking at is a consistent high single digit, at least, growth in the GDP over the long term. And I think that will drive a lot of the market movement in the long term. So if GDP itself doubles up, corporate earnings, you can expect to grow at least 1.5x of GDP. And that itself should drive a lot of the market movement going forward as well. So we're not really worried about the long-term story of India. We're confident that GDP will continue growing. There are a lot of ingredients that go into this. and we've got the perfect demographics, political environment, fiscal environment, prudent monetary policy, and all of those factors align very well with how we're positioned to achieve a doubling of the GDP. The point I'm trying to make is that if you're seeing that the GDP from here can double or triple over the coming years, there is no worry in terms of how the markets will perform. The direction is pretty. I think there is visible direction and there is conviction that that direction will follow. So we're not really. Oh yeah, here it is.
Yeah.
It was on this chart itself. Sorry, it was on this slide. So 20 to 24, if you look at the second chart on the right side, we've seen but this chart thoda, GDP growth of 7%, but earnings CAGR of 21%. If you take the next sort of 6-7 years where we've got ambitious targets in terms of GDP growth, if you assume that GDP CAGR, if it goes up by 10%, earnings growth will be much higher. And that earnings growth will directly translate into how the markets perform. So we're not really worried in terms of how the market direction is. Obviously, there will be near-term pressures, but we need to stay invested and we need to adjust our portfolios, make them a little safer, and ride the wave as it comes. In terms of portfolio positioning, obviously, this slowdown we had sort of seen it coming, because as I mentioned, there were cracks which were visible right from the election time, and we could see that the government intent will turn towards welfare spending. So what we sort of did is that we started creating a larger position in large caps. We started reducing our exposure to mid and small caps. That's one thing we did. And the second thing we did was we also started adjusting our sector exposure. We started taking exposure towards more defensive sectors, and we started exiting a lot of the growth oriented sectors which were very sexy over the last 4 years. So we started going for more boring sectors, more steady investments, more defensives. That is one. The second change, and the third change is that we created a more bottom-up approach and said that, hey, let's go a little more stock specific rather than picking up from a top-down perspective. What that helps us do is that despite the slowdown, we will pick out or try to pick out companies which are extremely good in terms of quality, have a lot of tailwinds not only from the sectoral standpoint but also their inherent initiatives, like companies which are seeing immense capex growth, which have exhibited strong performance, which have very good corporate governance, and which have the ability to steer through tough times as well. So we're also picking up a lot of those companies and cutting out a lot of the flab that we probably were dealing with in the portfolio earlier. So that's how we're positioned. One good example to show you how the portfolio has moved is the value migration portfolio. Harsh, if we could go a couple of slides ahead. There is a slide on. Yeah. So here we see the movement of the value migration small case in terms of how we moved over time. If you look at our risk aversion, it has increased slowly, and we've positioned ourselves pretty well before the market sort of saw the downturn. Our objective over the last 3-4 months at least has been to cap downside as much as possible, create safety in the portfolios, and try to weather the portfolio from some of the headwinds that we've seen. So I think we're pretty happy with how our calls went. This resulted in some bit of underperformance for us in the beginning, because the markets were performing well and we were sitting on cash, or we were very highly invested in large caps. So our portfolios had started underperforming. So we got a few questions from investors in terms of why we're being so safe and why we're underperforming. But it is precisely for this reason that we had created that safety in the portfolio long back. Even in the PMS, what we've done is that we've been sitting on, at least for the new money that's coming in, we've been sitting on cash and gold. So most of our exposure is in cash and gold. If any of you are invested in or have bought Voyager as a product from us, you would have realized that a lot of that also we are sitting in terms of cash and gold, which we have now started deploying. So coming to the last bit about what we think about the markets, we think that the downfall has been pretty steep over the last couple of months. Valuations still remain high. However, we are starting to buy now. So falls usually we look at as great opportunities to start investing in the market. Since the last week, we have started some buying across portfolios, and you can expect some amount of rebalancing to happen in the small cases as well going forward. Voyager also will start deploying some of the cash that we were sitting in starting next week. But again, as I say this, in the same breath, I'll also mention that we'll not go aggressive in terms of allocation at this point. We are just deploying a part of the capital or the cash that we've created. We are not still in a position where we're saying that the markets will turn around completely, and this is a pivot from what we've seen over the last 2 months. We think there is still some pressure to continue. Corporate earnings are going to be slow next quarter as well. So the next trigger that we see is in the form of a rate cut from the RBI. And I think at least the internal view is that this could happen in the beginning of 2025. So probably towards February, March is what we're thinking. And that's because so there are two things for any monetary policy to reverse or for any central bank to consider while cutting rates. One of them is that first of all, growth has to slow down, right? If there is no growth slowdown, there is no reason for monetary policy to boost the economy. You saw that across the world and now in India as well. Now that GDP is finally slowing down, the RBI can say, hey, let's look at boosting the economy, especially in the absence of fiscal policy aggression. So that's number one, which has started happening now in the GDP numbers and corporate earnings. And the second thing is inflation control. So our view on inflation is that although there is some moderation, it is still sort of playing with RBI's target limit of 4%, tolerance limit of 4%. So inflation is still sort of acting a little difficult to show a long-term stability. It has shown some stability in the near term, but the RBI still seems worried in terms of especially food inflation. A large contributor to that has been high vegetable prices caused by erratic monsoons. But now I think the Kharif crop is also expected to be pretty healthy. And one large change that is happening is that 2025 onwards, we are expecting a La Nina situation globally in terms of climate conditions compared to the El Nino we had in the last 4 years. So El Nino is usually that's the one that causes droughts and wildfires and erratic monsoons and stuff like that. Also a high temperature, and that's what's taken the globe over the last 4 years in terms of climatic conditions. But we're expecting, I mean, the weather forecast is that it will turn into a La Nina situation next year onwards, which is usually a favorable monsoon, cooler temperatures, better overall from a crop yield perspective and hence inflation perspective as well. So if we see, I think the inflation print over the next couple of months will be a critical number for us to monitor, where RBI also will probably be very stringent about in terms of taking rate cut decisions. However, as we know, the markets do not work on actual news; they work on expectations. So as and when the expectations of rate cuts start increasing, you might see some positive moves on the market. So overall, our view is that over the next 2 to 3 months in the near term, the markets are expected to be range bound. However, there could be a positive bias whenever the expectation of rate cuts increases. We had seen a similar situation in the US over the last year as well, where bad macroeconomic data used to result in markets going up. Because whenever the GDP number used to come lower or the employment number used to show some support, the market used to expect that, okay, now the Fed will cut rates. So whenever there were bad numbers, the markets would go up. I think a similar situation can happen in India over the next few months, where you'll see a range bound market, but with a slight positive bias based on expectations. But the overall strategy will continue to be bottom up, at least for us. We will continue to go on a bottom up approach in terms of stock selection. Yeah, I think we'll stop here for a bit. Let's take a round of questions before anything else. So we'll open it up. Anybody who has a question, you can probably, I don't know how it works on Zoom, probably raise hands and we'll unmute you and we'll take it. So anything in terms of market expectations, you want to ask about how our portfolios are positioned, what the strategy is, you're unhappy about something, you want to praise us for something, anything at all, please feel free. Yes, Advait.
Hello, can you hear me?
Yes, we can.
Okay. First of all, what exactly do you mean by a bottom-up approach in this context? And my next question would be, I am an investor in the value migration small case, and I'd actually like to know about how can I create a dip fund for the specific small case, and how big of a dip fund should be in percentage as compared to my total portfolio size.
Got it. Got it. Cool. So a bottom-up approach, we mean that sometimes when the markets, like for example, I'll tell you the last 3 years, we'd say that, hey, defense as a sector is going to perform well. So we need exposure in defense. And whether you picked up HAL, Mazgao, Bharat Electronics, Data Patterns, whichever stock in defense, you'd perform well. Similar for the power sector. Anything you picked up, whether it is in the financing in terms of PFC, or whether it's a private player like Tata Power, or whether it is some ancillary player like Hitachi Energy, everybody performed really well. Similar was the case for multiple other sectors where you could take a sector view, pick up any random stock in it, and you'd perform well. So a lot of the decision making was that where do we position our portfolio, which sector do we participate in, and then obviously, like at our level, given our research strength, we would prudently select the stock that would likely perform the best. So that was the approach we were also to a large extent carrying out. But I think now the approach is changing to saying that, hey, in the entire gamut, in the entire sort of 4,000 stocks, where do we see value? Where do we see companies that are, say, for example, increasing their capacity by 2x over the next couple of years, and are able to fulfill that and have the demand for it? I think there's a very large misnomer where people sort of say that, hey, capex ho raha hai, to invest kar do. Stock will do well, but you need execution of that capex. You need demand for that capex. So a good example from our portfolio of something that would be bottom up is EPAC, which we recently added. Chaitanya, maybe if you can highlight a little bit about EPAC in terms of what the thesis was, that will show how we're thinking bottom up when it comes to a stock.
Of course, definitely, definitely. So I think over the last few years, as we have seen that the manufacturing theme has been picked up quite well. So right from Dixon to even a smaller player like PG Electroplast, if you are aware about that, have seen a tremendous growth in terms of that revenue, and of course that resulted in the share price gain as well. But I think going forward, where these players are positioned will become more important, and that's why I think impact of our view is very uh, positioned well, because the second thing is also how these companies are dependent on self-dependence and also on the imports and all those things. So I think for EPEC, I think 75% of their sort of raw material is what they themselves create. It is a perfectly vertical integrated company. That's why their ability to weather the market downturn in terms of the sectoral downturn or other way are very well because of the less dependency on other variables. So that's why I think EPEC, and also EPEC is the second largest AC like a manufacturer. It is not a contract manufacturer play; it's a original design manufacturer. So you may have heard of a company named Amber Enterprises. It is a similar kind of a company, but this focus is completely on a room ACs, which is like the private consumption. And as we all know that it is at a very low penetration. The room ACs are, I think it is less than 10%, 8% to be precise. So as the consumption will grow, this is even not if it is direct play, but it is like a B2B2C play. So this EPAC provides these ACs to companies like Daikin, Carrier, LGs and Godrej even to some extent. So their growth is directly dependent on the consumer spending towards ACs. And that, of course, as this year itself is seen that ACs are now on even in November, which has been a very rare case earlier. So the heat waves and all those things, and because of the global warming and all. So I think AC's penetration will increase. Additionally, what EPAC is doing is they're trying to diversify away also from AC, because what happens is AC business is again a very seasonal business. So in summer times, your revenue will shot up incrementally, and then on the other times, it will not be that great. So they're also trying to penetrate into small domestic appliances, which is like air fryers and all those things, which has a more linear demand across the year. So that's why EPAC, why particular EPAC in whole of the manufacturing industry. So that is what the bottom up approach comes in very handy.
Yeah. So we had a similar portfolio company called PG Electroplast,
Yeah.
which we still like, and it appears in some portfolio. It was there
Mhm.
for the longest time, where we actually multiplied. We may have made a 5 to 7x, not sure how much, but 5 to 7x on
I think
this.
that was 10x from us. So that is
Oh,
also,
so from
yeah.
inception, it would have been 10x for us.
10,
And
yeah.
now we're at a place where PG Electroplast is a well-discovered stock. We picked it up when it was very little known.
Yeah.
And the story there itself also was that it used to make compressors for ACs. And from
Mm.
making compressors, it started making the outer body or the shell, the plastic coating, the cover that you see. Um, and from there, then it started getting contracts of where people start saying, "Hey, just build us the entire AC. We'll give you a contract for it."
Mhm.
And from ACs now it's gone to washing machines and fridges and stuff like that. And that is the expansion that we're talking about when it comes to one company's efforts, where there is product portfolio expansion and there is market expansion, and credibility increases as the number of customers also increases, which has resulted in a tremendous growth in terms of earnings as well as valuations. So we're looking out for companies like that, and EPAC is sort of fitting in that bill as an example where we're seeing that structural change and meteoric rise that can happen in a company's scale of operations over the coming years. To answer your question on value migration and the dip fund, I think what we're doing as an approach for any new customer is that we're keeping about 25% on average of their overall equity exposure in cash and gold at this point. This is something we've been creating over time. So we're not saying that right now liquidate 25% of your holdings and keep it as a dry cash. We've done that over time. So the strategy, I mean, at least at this point, if I have to put a number to it, it's about 25 to 30% in cash. And that cash will, I think, deploy in 4 to 5 parts over the coming months. So whenever we see a good fall and some subsequent buying happening as well. We don't want to blindly put in money on every fall. We should also see that there is some stability happening after. Like for example, we've only started deploying our money maybe Thursday, Friday, and probably on Monday, Tuesday we'll start deploying the money. So we are also waiting for some stability. It's not that market red mein dikha to utha lo types. So I think a good strategy is to probably a quarter of your money, keep it as dry powder, and deploy it in 4 or 5 parts over the coming months. Yeah. We can take the next one from Abhishek.
Hey, hi Sagar, Abhishek this side. So I want to understand regarding what your view on and coming. Um, so interest rate changes are maybe coming in December, I believe. So and there is similarly now the inflation number came. So any view on that? How would you look that? On that front, lot of news is about that. It's rare that interest rate will increase reduce further. So and I think that is one of the driver for market right now, which everyone looking.
Right. So I think we're looking at sort of Feb or March for when the rates will probably fall, or the RBI will cut rates only towards that time is what our internal view is. And we've come to that view thinking that the GDP has just about started reducing, right? You're seeing an impact on GDP just about now. So till the time there is no stress in the economy, there is no need for a stimulus, right? So that is the one equation we look at. And even when there is stress, usually monetary policy comes or at least waits for that stress to be pronounced or at least for it to be visible for a bit. It's not that one quarter your GDP number goes down, RBI will cut rates. Usually they wait and see how structural it is, how much of a trend that is. In terms of that, I think it is clearly established that we are going through a slowdown. Also because the base was very high. You have to understand that a lot of like what we are seeing in terms of a slowdown is not just stress related, but also very numeric in nature. You can't forever keep seeing 20% growth because the base increases and there is very difficult to achieve the same momentum over a higher base, which is happening with GST collections, for example. There is so much of that double digit growth we've seen, and now the base is just high, so you can't continue seeing collections at the same rate. So one is the stress. I think that has started coming into the market already, or the economy already. Rural stress has been there for the last 3 years. That is not new. But the other stresses have started coming. And the second factor, obviously, is inflation, which I think still there needs to be comfort that RBI, from an RBI level, that inflation is structurally lower now, which is not happening. So food inflation is still high, pulses the inflation is still high. And when food inflation is high, the RBI is a little less tolerant towards it because that is what forms the majority basket of spending for most of India, right? So all the sensitive strata of economy, food inflation is the one number that really affects. So that's one thing that needs to sort of be sustainably lower still. So we still, I think, at least a couple of months away from RBI considering a rate cut. And when the rate cut happens, you're right, that is going to be a trigger for the markets. But at the same time, I think our internal view, at least from the research standpoint, is that sentimentally things might improve, but on ground, for things to start turning around, it may still take some time. Because if you look at the NBFCs right now, most of the NBFCs are under stress because of stressed assets. There is stress in the economy, the finance sector. If you look at, again, we were discussing in the morning today itself that even the infrastructure spend is down. And if the government has to now spend on infra and they raise money through through bonds, what will happen is that the interest rate to be paid on those bonds will still be higher because the spending itself is lower. So there will not be many takers for infra bonds at this point. So the government will have to compensate bond buyers by giving a slightly higher interest rate. So even if RBI has to cut rates, say in February or March, as we're saying, if infra bonds are raised at a higher interest rate, that will still sort of negate the effect of the rate cut. So you won't possibly see, sudden stimulus and sudden boost in spending in the economy as soon as the RBI cuts rates. And hence we are of the opinion that sentimentally, yes, it will look great. The markets will be happy. The markets will perform well. But our caution will still remain for some time.
Yeah, that's great. So, like a few sectors you mentioned in your newsletter, like first is cement sector, FMCG sector, and I think textile sector somewhat. So, are you bullish about these sectors, and are you going to add this into portfolio in coming months, maybe?
So cement, we're still sort of in a place where volume growth is muted. A lot of the cement demand over the last few years has been driven by government spending and infra spending. And that itself has reduced, so we don't see much of action going on in the cement sector as a whole. So we think volume growth will be muted for cement, at least for the coming months. And whenever volume growth is muted, what happens in cement is that pricing also remains subdued. So pricing is also what we're seeing is that pricing is also weak at the same time. So cement is not really a sector which we'd be gung ho on. Unless and that's where I think we're coming back to the bottom up approach, where some of the smaller players in cement look very interesting at this point, and that's from a consolidation standpoint. So a lot of the smaller players are getting acquired by larger players. You've seen a couple of these deals happening where Adani has picked up a few players, and even Ultratech has. And so in this process, and this is something that has been ongoing for the last many years and is just accelerating now. So I think if we have to take a position in cement, it will be only in some small company which we think is a prospective company that will be acquired by somebody else. So that's one. But in terms of sector positioning overall, I think what we're looking at is that we're not yet seeing any revival in auto. Auto numbers are still weak. So we're going with ancillaries in auto instead of OEMs. We're avoiding cement. We may start picking up some defense because stocks have fallen so much. And there is visibility in terms of order book, etc. So that is something we might pick up. Other than that, we are positive on tech. Tech primarily because the US has seen a rate cut, and there is some improvement in sentiment, at least on business spending and tech spending in the US. That reflects directly in terms of how Indian IT companies perform, because 65% of their exposure is towards the US. So that's one area. The other area we're positive on, probably we're picking up some commodities. Then manufacturing and a lot of the export oriented manufacturing as well. So companies where either someone like Uno Minda or Samvardhana Motherson, where export portions are high, or something where we're looking at from a manufacturing perspective, we were assessing something like Triveni Turbine and those companies where again you've got a high manufacturing export exposure. So being very selective in terms of sectors, to be honest. Picking up a lot of healthcare. I think that's been one of the other things we've picked up a lot over the last 2-3 months, plainly from a defensive standpoint. Consumer, we're picking up or more comfortable with stuff that is to do with luxury. So that tends to be more sticky even during stressful times. United Spirits is a good example. Premium alcohol consumption remains sticky irrespective of what the cycle is. So that's the brief positioning right now.
Yeah. And maybe my observation is a little bit wrong, but correct me if it is. So what I'm observing, the if you compare the small cap, mid cap, large cap downfall, all are equally falling this time, and small cap, due to maybe FIIs are not there, or maybe some other reason, they are coming back again to the same levels, at least at the index level, quite quickly. Do you see that the behavior is changing in this? Like if you compare the previous behavior, small cap, mid cap are always big losers when you compare to Nifty large cap always, but not this time at least.
No, I think what will happen is that, see, mid cap and small cap valuations are still very relatively high compared to the large caps. So that comfort is not really coming in. So we're seeing that even right now, if you look at the mid cap valuation, that is 60% premium compared to large cap valuation, which is quite steep. So we're still in a place where I think what will happen is that mid and small caps will underperform probably compared to the large caps. So that's the view, and hence we are also sitting relatively larger in terms of our position towards large caps and not towards mid and small. So overall, I think the view is that with this stress, mid and small cap will be under larger stress compared to greater stress compared to large caps. But again, if you're placed in a quality mid or small cap company, or you've got relatively lesser stuff to worry about. Yeah, we can take the next one from Anil.
Hello.
Hi, Anil.
I'm invested in value migration, and
Yeah.
as per your answer to other question, you mentioned that as tip strategy, we should keep investing in 3 to 4 lots.
Yeah.
So I just want to understand in the small cases, when you invest a smaller amount, uh, get invested in few of these stocks in that small case. So how that balancing is like managed?
Right. So in small case, unfortunately, what happens is that because the amounts are small, what we've seen is that most customers, we are just one of the many products people have. Right. So if you've got a value migration small case, it's a very small percentage of your overall holdings. So what we usually avoid doing in the small case is that we don't take a cash position in the small case. If anybody sort of like reaches out to us and calls us and says that, hey, I've got some extra money, or what should my overall investing strategy be? Usually Aditya is the one recommending that, hey, sit on some cash right now and deploy that dip strategy when it comes to investing. So in the small case itself, we've been fully invested. We've not created a cash position within the small case because of that reason, that it's just one of the products that people have. But yeah, I think if you're looking at sort of investing further in the value migration small case, that's the same approach we'd encourage. Just keep some dry powder aside and keep investing whenever the markets fall. Not sure if that answered your question, but yeah, that's what you were sort of asking, right? Or were you trying to get to a point where we hold some cash in value migration? Is that what you're saying? Well, we'll just probably come back to that later. Cool. Sorry, we had one question in the chats also, no?
Hi, Sagar. This is Badri from Pune. I'm invested in value migration, small case. And my question is a bit related to what just Anil asked. So let's say I want to top off uh, at a dip, and out of 15 stocks that are there in the small case, few might be at say positive 15% and few might be at negative 15%. Is the algorithm smart enough to restrict me positioning more into the losers and adding more into the winners? How does the rebalancing, or how does the algorithm work, so that it how I can protect my investment, or I should not worry at all about all these things? Sagar.
Yeah, I think, see, the algorithm is pretty simple. What will happen is that because everybody's entry point is different, over time, your portfolio will deviate from somebody else's. But what we do at our level is that we create a model portfolio which is based on what the current market situation is. So we'll keep adjusting weights depending on what the market situation is and what we think is the best positioning at this point. So whenever there is a rebalance, I think you should not worry about the gainers or losers, but I think you should try and align it to the model portfolio as much as possible, because that's where we are considering and taking decisions of how much sector exposure and how much market cap exposure or deviation there should be. So every rebalance, I think, if you do not skip a rebalance and if you just go for it, I think your positioning will be appropriate and aligned to what we want it to be. Um, and what will happen with the algorithm or rebalance is that naturally, if some stock has fallen, you'll add more weight into that, right? Because some stock, say for example, is given 10% allocation and it's not performed well, it's gone to 8%. In the rebalance, if we maintain 10% exposure to that, you'll end up buying on the dip. And we will maintain 10% exposure to that only if we think the stock is positive and our conviction is still on it. Otherwise, we'll reduce it to 8% or we'll even remove the stock. So if the stock is there in the portfolio and is assigned a certain weight, I think whenever you rebalance, if the stock has fallen, automatically you will get a better average price on it. And if the stock has risen, but we've still maintained the same weight, you'll automatically book some profits. So I think the focus should just be on rebalancing on a timely basis whenever we roll them out. Don't worry about the allocation. That's our job. we're good. Yep, we can take the next one from Abhishek.
Yeah, so I want to understand regarding few of the stocks which are there in the our value migration portfolio. So one is the tube investment, like if like what is your view on the tube investment? It's grown a lot over time, and now still is in portfolio. And recently there is steep fall happened in that. So if you can just uh, tell something.
So Tube is actually one stock where I personally have gone horribly wrong. It was there in the portfolio. It sort of bubbled for us, and I was of the view that I was negative on the stock personally. But the team here, including Prasanna, who's not joined the call, he manages the value migration small case. He was extremely positive on Tube, right? So he kept it intact, and that was a good decision that he kept it in. Tube, I think, so now over time, looking at performance and looking at how the company has done, my view has sort of slightly changed. The thing with Tube is that it's amazing at um, getting into businesses either organically or through acquisitions that are not related to its core business. So it's opening up a new market and it's killing it in that market. You saw it with the acquisition of Chola. You saw it with the acquisition of this one, which is the CG Power. Um, it did extremely well in terms of turning these companies around, expanding the business, launching new products, revamping operations, restructuring business, and assimilating it into their operations. So it's done extremely well on those lines. So the last trigger of how it performed so well, CG Power was the major contributor of CG Power and Shanti Gears. Both of those acquisitions contributed a lot to how it went over the last few years. But now what we see is that they're starting a lot of businesses organically. They're getting into a lot of stuff, including semiconductors, including CDMO. They're getting into electric vehicle manufacturing, which is something I was not very positive about because they're doing it organically, but they're doing it amazingly well. If you are in South India, probably you'll see these vehicles, three-wheelers of theirs called Montra, which are performing extremely well. Now there's a lot of those seen around in the market. They're also the first ones to get into EV manufacturing for commercial vehicles as well as tractors. So I think the company is great, especially during this time. What we think is that we want to stick with market leaders. Tube is a market leader in multiple spaces and is expanding its market heavily. So I think we're comfortable on Tube.
Okay. Yeah. There is one more stock which, RR Cable. For that, I was just checking the numbers, and this quarter number was not good enough compared to peers, and even the management commentary. If you I checked, like it is not as they are not giving good futuristic numbers as well. So
Then could you repeat the company which you're talking about?
RR Cable.
Yeah.
So just wanted to understand your view on RR Cable. Whether do you still see the growth compared to with their peers?
Yeah. No, RR Cable, I think so the whole cable industry as a whole, I think, has been posting great numbers. So we've been positive on the cable industry, and I think one of the other things that we would like to play is that how cable companies are slowly moving to electricals. We've seen that successfully happen with Havells, which is also part of our portfolio. And if there is any other company, I mean, we've seen everybody else other than Polycab make a move towards making electricals and electronics. And RR Cable is also one of them where that move is slowly happening. So base business, great, good cash cow. lot of action in terms of government spending and housing overall increasing and formalization of the sector, resulting in double-digit growth in cables and wires. But I think their movement towards switch gears and basic electricals or consumer electronics will also aid a lot of the growth and valuation re-rating that will come through. So that's why we are positive at on RR cable and available at a decent valuation. To it.
I think secondly in RR, I think there's one to add one more point. They have a very strong distribution in the whole Western region. So I think even Polycab being in a Western heavy company, RR has been even more aggressive in terms of distribution and all. So whenever they will uh, come up with their FMCG kind of a product line, they will have a deeper rural penetration compared to other players, which really helps in a very small domestic appliance. जैसे आपका pedestal fans हो गया, and all those things. So these are very prominent used product in terms of rural areas. So where you're not gonna easily able to sell ACs in rural areas, but these kind of products which are at least at the start BLDC fans and all those things, those are very easy to sell in rural areas, which RR Cable is having a very good presence. So I think that will also tremendously help company going forward.
So Ahmed was asking a question on this thing. Liquidating portfolio and keeping 20-25% cash. I mean, I think it wasn't applicable to a lot of the people who came in at the right time. So there was, if you notice, like the markets were doing well. Then we felt that, hey, it is very elevated. When the elevation happened is whenever new customers were coming in, we were cleaning out a lot of their portfolios. So whenever a cleanup has happened before the elevation, I think we are good. We are not sitting on cash. When the markets
Yeah.
were at, what we've done is all of the stocks which are not good in terms of corporate governance, which we are not comfortable with in terms of valuation, when messed up portfolios have come into our hand, we've cut out a lot of the flab at that time. And that is the cash we're sitting on in Voyager. So all I think wherever the portfolios have been revamped before this peak came, we're comfortable, and your positioning would have also been such where large caps would have been heavier, defenses would have been heavier, so we were placed pretty perfectly at that time. The context for cash is only a little after when we got fresh money, either in the PMS or in Voyager, where we've done a cleanup, gotten rid of stuff at a high valuation, gotten rid of low quality stuff at a high valuation, so that we're able to now deploy money in better stocks. So I think it's very contextual. So if you're not sitting on cash and you're in Voyager, don't worry, it's safe. Your portfolio is anyway positioned according to when you came in and how the markets were at that time. So we're good. And then for those customers, we didn't want to sort of create cash at a low, right? When the markets are falling, you don't want to liquidate and create cash. So that would be a horrible strategy because you're selling at a low then. So staying invested is a great way that way. Sorry, Badri wants us to go to slide 2.
Sorry to interrupt, but just would like to address one more thing. The usual thing that I get from client mostly more often, that is when we are going to rebalance a portfolio, mostly for small case and like particularly value migration. So I would like to put some light, like the rebalancing is on need basis. So it is dependent on how market is performing and what is being thoughts aligned by the fund manager for the particular portfolio to be performed. But so basically you cannot link deploying more money with the rebalances. So the reason to ask this question usually people have is that they want to deploy some more money or invest some more money. So what ideally we would recommend, as Sagar rightly mentioned, that you should deploy your money in tranches between 4 to 5 in whenever we find a dip or whenever there is an opportunity. But to be very honest, the rebalancing would not affect much when you add some more money, as algorithm takes care of the remaining things. And yes, also would like Sagar, if you have any thoughts to put on it for the rebalancing stuff.
No, I think a lot of the question we also get is when we are going to rebalance. Like,
Correct.
so when we are going to rebalance is, I think, a very dynamic thing. Unlike like we haven't put a fixed that we'll do it on a monthly basis or we'll do it at. I don't think that approach works for us as a team. And that's because we are sort of constantly monitoring the markets and we are trying to take positions well in advance. And that can be ad hoc as well, because you can't time the market fall, right? If I say every 15th I will rebalance my portfolio, but there is an opportunity that arises tomorrow because of a market fall, or because some stock in my bucket list has finally come to great valuations, I'll rebalance tomorrow. Um, I'm like a lot of people, I think, ask about the rebalance from the perspective of saving cost. That hey, if you invest in a certain portfolio today and we rebalance immediately, there is a transaction cost or broking cost involved. Uh, we'd like to have that visibility or give you that visibility in terms of saving that cost, but unfortunately, the market is the king here, right? So the market unfortunately doesn't tell us what it's going to do the next day. We react when the market does its plan. And we think that the transaction cost is going to be extremely meager or minute compared to the larger benefit that a rebalance would provide. So anybody sort of looking to time a rebalance, please don't um, leave it to the markets. Value migration, negative returns. Value migration, negative returns is at least it's lesser than the market negative return. Maybe no, I think what's happening is that we'll be rebalancing the value migration small case sometime next week. And what were yeah, no, it's performed worse than the market. Right. No, I think we're good. We're comfortable with the current positioning. You should again focus on the long term, really, because these short term aberrations will keep happening. The markets are so volatile right now. The sector which performed 2 weeks back has not performed last week. I don't think you should look at 1 month, 3 months, and worry about those negative returns. Keep your eyes on the last column of 3 years where value migration has done 171%. We'll hope to replicate that in the next 3 years as well. So let's stay focused on the long term. Don't worry about the negative returns in the near term. It's a function of how the markets perform. Anything that goes up has to come down at some point at least. The other thing with value migration is that, again, I was talking about the base effect, right? That is showing in value migration now. We were sitting on some 100% return. If you had seen the same slide in our September presentation, value migration would have been at 80-90% in terms of the 1 year performance. But that rise that you saw last year, on top of that, to generate a similar rise in a market which is much worse, is mathematically and practically not possible. Hence, I think the base effect is showing in value migration. Comparison of products is on slide, I think the previous slide. This is the one. Sorry, Advait has another question.
Yeah, hello, can you hear me?
Yeah.
Okay. So I have two or three questions, not just one. First of them would be, do you plan to introduce a robo advisor or an algorithmic analyst like some of the other fund houses that offer small cases? That would be my first question. My second question would be that I have left all my equity management in a way to you, and I am looking forward towards actually building my skills on how to plan my finance and how can I have a more balanced, complete investment portfolio in general. I'm just 19 years old and I'm a like second year student of dental surgery, so I practically don't have a family of my own. I don't have responsibilities, and of course, that is ought to change in the next 10 years. So I have left my equity investments to you, and I am not actually able to figure out what portion of my total net worth should I have in instruments such as debt or gold, because everyone, like, there's just so much noise that everyone seems to say something different uh, about my total investment, like percentage breakdown, I'd rather say, in like debt or gold, and my portfolio should be. And my third question would be, you said that there is like it's advisable to have a dry powder of about 25% of your total current portfolio, but we have seen in like throughout history, like the Great Depression of the like from 1929 to 33, we have the oil crisis of the 1970s. Then we have the dot-com bubble of the early 20s, like I think from 2000 to 2002. Then we have like the global financial crisis from 2000s. Like we recently have a COVID crash in 2020 where markets fell more than 30%, 50%, 70% even. So how advisable is it to have dry powder of just 25%? And if I actually have more dry powder, if I actually have a bigger dip fund, am I not missing out on the compounding opportunity? Because having a larger dip fund basically means having a larger portion of cash that is not compounding, that isn't doing anything, that's just sitting there. Or should I allocate some of my dip fund into debt or gold, like, or any other investment instrument? So like these were my questions.
Yeah. So on the robo advisory bit, I think, see, at this point, at least 3 years of being in business, it's still we're still pretty young, right? So I think, and we're rapidly expanding because we've got small case, we've got Voyager, we started PMS, we're now getting into wealth. So we're doing a lot of things, and robo advisory is something that is definitely on the card, not something that we want to tap into immediately. Focused on fundamental. All of us are people who've been in the markets, the fund managers and me and the investment team. We've been around for a long time, only in sort of fundamental analysis, and we're good at what we do. We like what we do. We have our little comfort zone at this point, and that's bringing us business and money, right? So we're sort of comfortable at this point in time. That's definitely on the cards, but that will again require a lot of new additions to the team, not just from an investing perspective, but also from a tech standpoint, which I don't think we are in a position to make investments in at this point in time. But of course, at the rate we are growing, it's hard to say when we'll add it. Sometimes the rate we are growing, I plan something for 2 years down the line, but start working on it within 3 months. Sometimes it goes the complete other way, where we plan something for the next 3 months, but things go wrong and take some more time. So definitely on the cards, but we just can't put a timeline to it. Um, in terms of equity and your overall investments, I think, we are taking initiatives towards starting wealth management. I think we in fact did start just a month and a half ago. On a very soft basis, we've started working towards wealth again with our very close Patterson partners. And there, I think, if you need any help, I think what we're in a stage where we're just speaking to as many customers as possible, helping them out, seeing where we can help, what we can provide. We've got some, just like Voyager, where we take over the entire equity portfolio. We're trying to build something on the wealth side as well, where we take the entire assets of a person and recommend a good asset allocation strategy and stuff like that. So if you want to have a word with Aditya, is again driving that initiative for us. So Aditya is our man. So at any point in time, if you actually dial our number, the one on the website, it'll directly reach to Aditya, and you can get in touch with him with any questions regarding the overall investment bit. Must say that at 19 you're thinking a lot in terms of your wealth, and really happy to see that at 19 we were just wasting our time. So very yeah. And the dry powder bit, I think you compared a lot of the situations which were very dramatic in nature, the Great Depression or COVID and stuff like that, which, or even the GFC. These were situations where there were systemic collapses, which is not the case right now, and that's why I think we keep our vision pretty focused in terms of saying that, does India have the demographic strength, the fiscal prudence, or the power and the systems in terms of political stability and monetary policy to achieve, or just in terms of strategy as well, to achieve doubling or tripling of the GDP in the coming years. And if that answer is a yes, and you're seeing movement towards it, you're seeing action towards it. It's not just there is talk about it, but there is no action towards it. You're seeing progress towards it. You've seen it over the last 10 years. You're seeing it now. If that direction is something that that you can see and you are on the path of, then I don't think we should be worrying about or looking at this fall as a major collapse of a system. I think this is just a temporary aberration where obviously things are not going to go in a very linear fashion. Any linearity, at least in the real world, goes through some bit of up and down, and this is just one of those. We're also in a place where, if you notice, the last few years, a lot of the growth was driven by fiscal spending and monetary policy was regressive. So, monetary policy, we were in a rate hike cycle. And despite the rate hike cycle, the GDP was growing because fiscal spending was very high. So, fiscal policy supportive, monetary policy regressive. That was the situation. Now, what is happening is that fiscal policy is being less supportive, more towards welfare and stuff like that, and towards maintaining a fiscal deficit. And monetary policy will take the load of driving growth. So, that shift is what we are seeing, and that shift is causing this aberration in the market. So, I wouldn't worry about it, to be honest. Keeping a dry powder of just 25% is not how I would term it. I think 25% is also slightly on the higher side. A lot of the portfolios which are perfectly positioned before the market fall, we are not even sitting on any dry powder because the position has been appropriate to cushion the fall. I don't think you should be looking at dry powder as inadequate at a 25% level. Um, if at all, I think it's a little on the higher side. Staying invested is the only way for creating wealth in a where I think in a once in a lifetime sort of opportunity when it comes to the Indian markets. So staying out of it would definitely be a mistake that at least we would not make. Yeah. The recording of this will be available. This session is being recorded. We'll be putting it up on YouTube, and we'll send you all a link in the next newsletter. So that's something we'll do. Badri has a question.
Yeah, hi Sagar. I have kind of a inquiry kind of questions. So in the slide we can see you have different products such as PMS, Voyager, and small cases. So let's say a person is having funds between 5 lakhs and 50 or 60 lakhs. So what disadvantage does he have if he goes with small case as opposed to Voyager or PMS?
Sorry, what disadvantage does he have if?
Yeah, so let's say I have more than 50 lakhs and I keep on investing through small case instead of Voyager or Patterson. I mean, is there a disadvantage?
Not really. I think what you should be looking at is small case. Every product that is mentioned on this slide is in effect asset management, right? We are doing some bit of portfolio building or construction and management. The only difference is that in Voyager and PMS there is a high level of customization and personalization available, which is not available in small case. So in the PMS, for example, when you give us the money, you're not directly investing in the model portfolio. Model portfolio, the weights are already assigned, you're just buying into that. When in the PMS, we're taking money, we are able to judge when to buy, what to buy, how much to sell, how much, whether to skip an entire stock because the valuations seem high. So, for example, right now, if the money comes in and we think that, hey, XYZ stock is too high in terms of valuation, we don't want to buy it this time, we'll sit on cash. The fund manager anyway is looking at it on a daily basis. Whenever now, for example, the markets fall over the next week and the stock corrects massively, we're able to then deploy that cash there. So I think we're just able to optimize decisions at a personal level when it comes to the PMS, which we are not able to do in small case as a product, because small case becomes a one size fits all product. If you are invested in small case and that is one of the investments that you've made, then I think it's completely all right. There is nothing to worry about. But if you want personalized attention and customized portfolios to be made, then the PMS at least takes care of timing of the market and what you're interested in and how we're doing it. Voyager is, I think, you should be looking at as a product where if you have an existing portfolio which is a complete mess, and not a complete mess, even if it's lacking direction, because you've maybe bought some stocks by yourself, you've bought stocks through some recommendations, you've bought a few small cases. What we see in Voyager is that people end up with a stock portfolio of 50 stocks, 100 stocks, sometimes 150, 200 stocks. That's where I think our role comes into picture, where we are first, I think the step is to take out excess flab, cut out on what is not required in the portfolio, optimize that at least in terms of number of holdings, get rid of bad corporate governance companies, get rid of companies that will not let you sleep at night, get rid of all of that, and then finally come to a place where you deploy that cash strategically to adjust to the market condition, as well as buy stocks which are great for the long term at a great price. So again, a very personalized and customized approach. Voyager is, but however, something where look at it as course correction and management. PMS, anyway, I don't think people invest their entire wealth into the PMS. PMS, people look at it as a mutual fund only. I mean, for the rich, I think anybody with like 2 crores, 3 crores of a portfolio, they will opt for a PMS. Not somebody with just, I mean, as soon as they reach 50 lakh, they won't give us their entire money. It's usually that they're invested in 2, 3 different PMSs. So they look at it as a fund, but we're just able to optimize it better because of having more control of their money. So it to be honest, to answer your question, it depends on what you're looking at. If you're looking at something personalized, I'd highly recommend opting for Voyager or PMS. But if you're looking at it as just one of the funds that you are invested in, which makes you money, then small case is perfectly all right.
Yeah, so paying 2% per annum, does that result in significant, higher returns as compared to small case?
Oh, as compared to small case, we
Yeah.
don't have history yet because the PMS
Yeah,
was
okay.
6 months ago. The aim is, of course, to be able to do that. The aim is to be able to time the market also and get that maneuverability. Sometimes also we have the flexibility to take futures and options positions in the PMS, right? If we think the market is going to go down, or to protect from the downside, if we want to hedge ourselves, we have the option of going short the Nifty and stuff like that. So the aim is to at least be able to give people a worth of that 2% by giving much more return. From a theoretical standpoint, yes. Practically, we'll have to see how it goes. But at least over the last 6 months, we've been pretty good. And most of our outperformance in the PMS over the last 6 months has been plainly because of sitting on cash and gold by not being invested or whatever. Voyager versus PMS, I think again, as I said, PMS, people are not giving us their entire um, equity holding and saying, hey, I'm putting it in your PMS. That rarely happens. So if you want your entire equity investment to be taken care of, then Voyager is the product. If you're super rich and you're saying that I want to invest in a product but not a mutual fund because I want higher returns and I want personal attention, then PMS is the product. But if you want us to sort of take care of your entire equity holdings, no worry at all, no stress, completely get hands off, then Voyager it is.
Thanks, Sagar. That answers my question.
Cool. So I think we're done with questions and addressed most of what was on the chat as well. Oh, sorry, there is more. So there's one question on from a strategy perspective, does value migration look at selecting stocks from sectors which are showing long-term sectoral tailwinds? It actually does, but this can vary from long-term tailwinds to short-term tailwinds as well sometimes. Because if you look at, like, a classic example is defense over the last few months. long-term tailwinds are there, long-term story is in place. But have defense stocks done well over the last few months? No. So I think the markets are not only about whether something looks good in the long term and you stick around. Sometimes you have to time it as well. So the value migration small case itself, what we did was we have gotten out of Mazgaon dock after making a good 4x return. And we got out of Mazgaon dock not because the long term story is not there anymore. The long term story is very much there. We love the stock we love the company from a long term perspective. But that's where you have to understand that there is a difference between liking a company for the long term and liking a stock for the long term. While we love the company, we've gotten out of the stock. We may relook at investing in the stock at some point. Even now, suddenly defense has gone down so much that valuations look good. So we might just add something in defense. Yeah, and the other sectors that you've mentioned, in some form or the other, what happens is CDMO and stuff. For example, there is a play in tube investment. Sometimes pure play companies become very difficult to find, especially in emerging areas like renewables, for example. It's very hard to find companies which are purely focused on renewables. Even if you're looking at biofuels, for example, difficult to find a company which is completely focused on biofuels. So we try and find companies which have an exposure to that, who are making attempts to succeed in that particular area, and who can benefit out of it. With renewables, we like Tata Power. Tata Power has a very large portfolio of renewables. It's one of the private players which is very aggressive on the renewables portfolio. So, and with the entire Tata group taking on manufacturing of solar panels and stuff, we think there'll be a lot of opportunity for Tata Power to expand in the entire solar space as well. We take exposure basis that geospatial. We do have a company called Genesis International, which is part of our monopoly small case. What happens with small cases is that we've tried that every small case is managed by a different fund manager. Also because that helps us diversify returns and spread it across products as well, right? We don't want a situation where all 5-6 small cases together go down. So there is a lot of decentralization in terms of decision making in our company, and we respect that there. So you might find that we like a stock, it is there in one portfolio or one small case, but not in the others. So that's I think unfortunately going to happen. We don't want a situation where we have the same portfolios across products and that goes down. Yeah. So wow, Advait is very well read. So the question is, value migration, how true is the strategy to the book by Dr. Adrian? Actually, interestingly, this name and the concept also came from the same book that you're talking about, because this is something I'd worked on as a strategy when I was working in Motilal Oswal. So found that very interesting and said, let's try to replicate it here. See, I think if we look at the portfolio, even at this point in time, a lot of the bets are basis tailwinds or basis value shifting from one place to another. And the definition, fortunately, is so broad that it gives us the benefit and flexibility to maneuver around, interpret the value, and capture these trends. And I'll give you an example, right? Sometimes, like what you can look at value shifts is also value shifting temporarily from growth to value. Right, like in the market, growth stocks have a certain period where they'll do well. Then suddenly value stocks will start doing well. You'll be in a place where defense cyclicals are doing well, for example. Right now, structural stocks will do better at some point. So these value shifts keep happening, and I think even any portfolio adjustment that we make in order to capture this sentiment shift is also something that we count in this. So when we say that we try to make our portfolio safer by taking exposure in defensives, by adding consumer, healthcare, and stuff like that, that is also where we're seeing a shift of value from risky assets to slightly lower risk assets. So that's also something we're capturing. So any decision in the value migration strategy, at least we are taking from the perspective of, or we're thinking from the standpoint of where is value shifting and how are we able to capture it. That can be a short-term value shift in terms of how the market is looking at things or perceiving things. That can be slightly long-term and fundamental in nature in terms of value shifting from traditional businesses to new businesses, or that can be very long-term, where value is either shifting or even being created. In some of the examples that we gave, for example, like PG Electroplast, where there is a value creation happening and value shift happening from manufacturers, or electronics manufacturing shifting from branded players to contractual basis. So I think, yeah, value migration strategy, most of it, at least the thinking part, we do follow the principles and try to stick to our interpretation of what value shifts are. Cool. Abhishek has another question.
Hey, thanks, Sagar. My last question, maybe like I missed to ask. So, Nifty, the pharma. So you are talking about a lot about pharma. There are opportunities, but other side, if I see, pharma has gone a lot, grown it's almost double. If I see that its index. So just wanted to understand, like, why do you think it is there are more growth opportunities, looking at, regulations which might come after, once Trump again come into the as a president.
Right. So in pharma also, I think we have multiple plays. One of them, for example, is Lupin as a play we've got. Then we've got something called Sequent Scientific, which is a pharma play, but for animal healthcare, which is very differentiated from what we usually see in pharma plays. There is one more, Chaitanya, you'll have to help me here in terms of the
Yeah, I
pharma.
think so. In CDMO space, we also like Piramal Pharma that has been doing quite well, which also has some OTM, OTC medicine exposure. So that also helps them in, consumer facing products, so it helps in valuation point of view because they have their own brand and stuff. We also like Lotus Lab from a long term perspective. Again, it's a very keep happening every quarter that the how much longer the wait should be, how much longer the wait should be, but I think we have been fairly confident on that part to be played out. So hopefully in the next couple of quarters we should also start seeing results from that end as well. And
So
more or less on the hospital side, also we have a few picks such as Global Health, which is coming up with a massive bed expansion. So I think that is also that we see that higher value because medical tourism is also something which is going in favor of the all these hospital players. And of course, the Apollo is being the market leader is among the our favorite stocks as well.
yeah, sorry. So on the pharma side, I was also saying that Laurus Labs is a good example of how we are picking stocks. It's not necessarily about what the sector is up to and what regulations in
Yeah.
the rise. But if you look at Laurus Labs, the story has been that majority of its revenue or its expertise was in anti-HIV drugs. So it was an expertise in, and majority of its revenue came from antivirals or HIV medication. And it has diversified its portfolio significantly towards including not just HIV, but into diabetes, into other cancer treatments, into stuff like that, cardiovascular as well, where all these new therapeutic areas and specialized sort of presence in these areas gives it a much more diversified play. So it reduces the risk and also increases its addressable market by a lot. So that's the story we're trying to play in Laurus Labs. And as Chaitanya mentioned, the other parts also. So when we're looking at healthcare, we're just not sticking to pharma research or manufacturing. We're also positive on the entire hospital space. So multiple plays available. So I think when we look at pharma, we also do some we get a sort of diversified play rather than just sticking to one, which will obviously keep shifting over time. Right now, for example, you'll see Lupin in the portfolio, but at a later point in time, when we feel that hospitals are much safer to go with, we'll even shift exposure there. So, any other questions, or we could probably wrap up if there are no more. So, great. So, thank you all for joining. It was great interacting with everybody. As usual, if there is anything that we can help with, we are always available. You can either mail us or call on the number. Aditya here is more than happy to assist you with anything at all related to investing. Doesn't only have to be small case or any of the products that you're seeing here. Something that we've been also actively doing is we get a lot of requests in terms of, hey, we've got some extra capital to put, but when do we put it? When do we know this is the day that we put it or whatever? So if that is another question you guys have, please you can just drop in a WhatsApp to us on the number that we've got, and we'll probably add you to a list where we'll just notify you whenever we feel the market timing is right. So for example, say Monday or Tuesday, we feel that we are deploying cash across PMS, Voyager, etc. But you need help even in topping up your small case. But obviously, we don't have the mechanism to do that on the small case app. We'll just send you a simple WhatsApp message saying, "Hey, good time to put in maybe 1/5 of your dry powder or whatever," and we'll help you with that timing as well. And yes, anything with wealth also, we're available. We're starting that out. So, not saying that from a business perspective, but purely from a need perspective. If anybody's got anything, we're happy to help out. So, yeah, look forward to seeing you next time. Recording will be available. Thank you all for joining. Thank you for your time.
Thank you, guys. Thank you very much.